So we're going to have two great papers today by two great presenters, Andrew Karolyi and Yukun Liu. And the topic of today's session is token classification, which is a very important topic because we have like more than 20,000 tradable tokens in the market based on CoinMarketCap today. And these tokens have very different applications, very different functionalities. Some of them are just general purpose tokens, also called coins, like Bitcoin or Litecoin. You can use them to buy a car or a house, or at least that's the ultimate goal for these tokens. They're not necessarily tied to a specific product or service. And even among these general purpose coins, you can further classify them as like stable coins or based on their technology, whether they're proof of work, proof of stake. And then on the other hand, we have tokens that are local means of payments on platforms that provide specific services or functions. Like we have this economy peer-to-peer storage system like Filecoin, and then we have Filecoin tokens that you use as a medium of exchange on this platform. Or we have decentralized internet platform called Helium, and then we have HNT tokens that you can use them as a mean of exchange. And these different classes of tokens, they have different properties. They might have different pricing properties. The underlying economy is different. So it's good to distinguish between them and try to understand them better as a different class of tokens. So that's the topic of today. I'm gonna set the stage for Andrew, the first presenter today. He's gonna present value premium, network adoption, and factor pricing of crypto assets, co-authored with Will Kang, Ke Tang, and Wei Zhao. Andrew, the floor is yours. We're gonna have 30 minutes presentations and then 10 minutes Q&A at the end.
Hey, Amin, thank you very much. Can you guys hear me? Everything good? You can see it? I'm thrilled to share the stage with Amin Shams and Yukun Liu. Amin is a student at Texas of one of my own students, John Griffin. And so, Yukun Liu, many of you might not realize, did an undergraduate degree at Cornell in economics, and I was very pleased to be one of his advisors as an undergraduate student. So what that all means is Andrew is old, and he's lucky to be here. So thank you very much. And I'm thrilled to present this fun paper with Will, Ke, and Wei Yi on value premium, network adoption, and factor pricing. So I'm going to give you 3 slides that basically tell you what the paper is about, and then we'll see how far we get in terms of details. So this is crypto anomalies in search of a factor model. It's all about the cross-section of asset pricing. It's really introducing to the literature an incredibly rich data set on cryptos, 4,000 plus, with fundamental characteristics across subclasses, just beautifully set up by Amin at the beginning. And it's basically invoking traditional, straight down the middle, true blue asset pricing techniques to understand these factor structures, essentially descriptors of this broad cross-section and time series, typically over a 5-year period in this particular paper. We're going to look at return patterns. There's some key findings here. The momentum phenomenon that we've seen uncovered in previous papers, including by one of my shared colleagues here on the stage, Yukun, is only confined to the largest of cryptocurrencies by market cap and not in the small ones. It's kind of an interesting insight. The value premium is much more dramatic for smaller when you incorporate a broader cross-section of smaller cryptos. And there's this network adoption premium. It's another class of factors, if you like, we're going to bring to bear on this. We'll describe more. There's some evidence of additional factor premia related to these characteristics and attributes as well. Out of this comes a second big finding, which is the emergence of a new 5-factor model coming to the forefront for the crypto space. We use a number of traditional types of tests to come to this conclusion, this consensus, that this 5-factor, we call it the C5, crypto 5 market, small minus big, a value premium, a network premium, and momentum is a good, solid, reliable workhorse descriptor of this broader universe. But we don't stop there. There's a third part of the paper that is kind of fun. It's probably the reason Will and Wei Yi invited me to join, which is bringing to bear an understanding of token classification and segmentation. So, as you know, I'm an international asset pricing guy, and I've been involved actively in analyzing the extent to which markets around the world are integrated or segmented, typically by countries, and looking across regions and even globally. Well, think about the universe of crypto as a giant global universe. And the idea is that there may be some subclasses of tokens by general payment flavor, a platform flavor, a product related to a particular service flavor, just like Amin said, that may mean, think of those as like countries, sub-countries, where there is stronger common covariation in the returns within the subclasses or subcategories, such that they might render very different inferences about what factors are priced in the cross-section if you acknowledge these strong local common covariant structures. And we find that that's the case. Taking the lead from in a previous paper, we have these 4 categories of tokens. And we actually find that there are strong market segmentation effects, suggesting that there's a strong concentration of investor interest among the cryptos within these subclasses that is much more important than any kind of integration or cross-class investing that's taking place among the investors to this point. Which brings us to the 4th and final big finding of the paper, the newest one if you've seen a prior working paper, which is that there's some really interesting dynamics going on. So we have these rolling windows using these traditional asset pricing techniques, and we find that there's some evidence that not only does the C5 5-factor model, crypto 5-factor model, seem to continue to perform well relative to alternatives, but there's evidence that these segmentation barriers are waning. They're easing, they're backing off. That's totally new to it's going to be in the next version of the paper, and I'll show you if I get a chance some of these cool graphs that we can generate about the dynamics of this. So I don't think I need to tell you. I mean, you set it up. This is a big market. The risk-return trade-offs are interesting to us. They're interesting to the world of crypto investors out there. There's clearly some really interesting early findings on which we can build and learn more. Fundamental factors like network adoption, value-based factors like we think about in terms of sort of a horizon and sort of a something to price ratio kind of value-based premium. And then again, there's this interesting new way of thinking about categories and subcategories related to functionality of tokens and for their different purposes that seems to bear out in the pricing. So that's a big finding, I think, and a cool one. And then, of course, the market dynamics. I think that's really something that we can learn from. This is a 5-year horizon through 21 that we look at in our analysis. And I can only imagine how to extrapolate out into the future once you see some of these graphs about how the dynamics are evolving. I don't think I need to tell this audience. I don't know how many people are on the call. I mean, but their names are all over this place. So clearly there's lots of talk in the literature about network effects, user adoption. There's some really cool papers by even our distinguished host looking at network effects with his study on subreddit pages. Clearly there's an existing literature on crypto fundamentals. But the real, if you really want to hone in on our contribution, what you want to do is basically look at Yukun's work with Chavinsky and Wu, Li and Yi, another currently working paper looking at factor structures in crypto, and mash it up with the work of Will and Xiao, Song and Xiao on classifications. It's really a mashup of those two sets of papers with a nice little wrinkle on this segmentation related to categories, those new findings. And we think of it more of as a traditional asset pricing paper than a crypto paper, but you know, we call it how you like it in terms of classification. The reason this paper can be written is because we basically are mashing up two big databases. The CoinMarketCap database, which a bunch of the papers now use. And this gives us a harvest of 8,000 plus cryptocurrencies in the sample. And then what we're going to do this special categorization analysis that's in the third and fourth part of the paper is mash this up with the into the block fundamental data, which gives a lot of data on addresses, basically the take-up that's happening on each of these types of tokens, and how much actual volume of activity, the sort of the real activity that's inside these currencies. And so our ultimate database, well, I'll show you another graphic on that, is this. Think about it as about 745 crypto coins for that meaty part of the analysis in the back third and fourth part of the paper. And there's some data cleaning exercise where we try to exclude things like stable coins. We clearly have to deal with a lot of missing data issues, and there's a whole protocol that's laid out in the paper on how to clean these databases. By the way, I think this exercise of data building is actually potentially a nice contribution to the literature in and of itself. So here's how you should think. It's the full sample, the 8,378 cryptos from CoinMarketCap. Ultimately, we're going to do some cleaning exercise and reduce that to about 4,000. Think of that as the universe, the full sample. Then we want to do some comparisons with our predecessor papers like Liu et al., LTW we're going to call it. And this is mostly just large cap subcategory. So we're going to want to do those contrasts and comparisons because there's some cool insights there. And then ultimately marry our full sample with the into the block data on network stuff. And that's what reduces the 4,000 down to the 745. Does that make sense? The distillation here and the playgrounds within which we're going to do our experiments. This is just a simple graphic of the number of cryptos that are continuously being added to the sample over the period of time of our analysis. What I think is interesting here, when you compare the full sample and the core sample, is while the counts are different, clearly different, what you can see is on a market cap basis, the left graph, is that the core sample is pretty darn representative of the full sample because it's market cap weighted. And that's not probably a surprise. Obviously, I'm sure that affirms your intuition here. So we have some first preliminary throat clearing experiments, right? And here, all we're going to do is I've got two slides here where we're going to do some compare and contrast with LTW. We want to affirm what they found using our database, basically, replicate, as it were, and then see how our inferences might change as we broaden the universe in our core sample, our full sample. And you can see here on the size premium, the SMB. Ladies and gentlemen, look at the top, look at the bottom. These are Decile Portfolios. And what you can see is in the large cap sample, just like LTW, the size factor is kind of meh. It's kind of meh. There's not a large spread, about 1.7%. I think these are on an annualized basis. And what you can see here is that when you broaden it, the small minus big, you get a much larger spread when you include much more of the truly smaller capitalized tokens out there that are trading in the marketplace. Very affirming of the importance of building out the broader sample to get a full characterization. So the small size effect is actually much stronger than what we thought before. Momentum, it's an interesting kind of flip here. If you look at the large cap sample, we affirm, just like from LTW, the importance of this sort of trailing momentum. Now, we're in weekly returns mode here, ladies and gentlemen. So our momentum characteristic here is a 2-week trailing momentum factor, right? 2-week and then sort and then hold for the next 1 week. And you can see we reaffirm about a 5.4% premium for high versus low momentum. But it turns out that including the much larger class of smaller cap tokens into the sample is distortive. It's distortive to that inference about the actual importance of momentum. It's much weaker, and in fact, it kind of goes away when you include the broader sample. There's a two-way sort on the bottom, small to big in the actual rows, low to high momentum across the columns. And what you can see is just how interestingly concentrated the momentum effect is in the ultimately the largest quintile. Do you see that going from minus 70 basis points up to 3.4%? That 4.1% spread is concentrated in the top quintile, and you don't see it in the other four. Again, affirming of the importance of building out this broader sample. How am I doing, Amin? About 14 minutes in so far, I think. Okay.
Yes.
Good.
So 13 minutes in. 13
minutes in. Okay, so I'm still doing okay.
Yeah.
So what we want to do now is, now that we've built these common understandings using the bigger sample, we're now going to hone in on our core sample, where we're going to bring to bear these network sorted portfolios. And we're looking at four kind of characteristics, looking at the take-up of these tokens, the total addresses that have some kind of balance there, volume on chain, transaction volume on chain as well, in terms of dollars versus counts. And you can see this example is for the BA growth and the TA growth, which are the two on addresses. And you can see there's some evidence, this is quintiles, a 5-1 quintile exercise. There's some evidence that tokens that are experiencing higher growth in terms of the number of take-ups in terms of addresses seem to have a higher return on average than those that have lower take-up. And it's not a trivial spread in terms of the actual magnitudes, 4%, 2.8%, depending on which characteristic you lean on. And there's some evidence of reliability there. So this is another new finding that we're bringing to bear on this. Now we move to the second part of the, which is, okay, so now we have this broader experimental setting. We're understanding there are going to be some new inferences that come to bear. What do we do? How do we build some kind of nice, convenient descriptor? That's what factor models are, after all, a convenient, reliable workhorse descriptor of this broader set of assets. And so we construct several of these factors using techniques that are well familiar in the asset pricing world. This is very, very Fama-French style building of an SMB, right? A 2x3 sort on the full sample, because we can, for small minus big. And value happens to be the one that we use a lot here, is based on the negative 52-week return as a sort of a long run reversal for a measure of value. We have other ones. We have 4 other measures of value as well, but this is the one that we feature. So those ones we can build off the full sample of the 4,000 clean data, because they don't rely on any networking. The same with the market cap momentum one. We do the same kind of 2x3 to get the momentum. Because there's a reversal in the smallest cap group, we let Rev, what we call a reversal factor, come and play in the mix and see how it delivers in terms of a descriptor. And then net is constructed just from the core sample, because it can only be built from the core sample. And we do a similar kind of 30-40-30 grouping, and create net out of just a simpler kind of long short factor structure. And so, and we want to do a little juxtaposition with Liu et al. And so we build the equivalent of their 3-factor market, SMB, and momentum, which is what their workhorse was, defined for their subsample. We build it like they would have from just the large cap sample, and let them sort of see how they play out in the broader cross section of these experiments. Now we're going to have 150 portfolios as test assets, and we're going to do the usual kind. They should all be very familiar with you. What we call left-hand side and right-hand side types of tests for which ones of these models come to the fore. The left-hand side test assets are 150 portfolios constructed from different characteristics, all piled up, and then we throw each of these models, each of these 3 kinds of models against these. And we're going to use a number of different metrics of performance. I can tell you what our favorite is as a team, where our eyes go, and you can already see it on this graph. We really like this Cooper and Meow constrained cross-sectional R-squared, where it's basically a cross-sectional R-squared across returns against loadings. where it's basically, instead of a freewheeling cross-sectional experiment, they actually constrain the coefficients to be the actual de facto return spreads on the factor premium. So you get some big fat juicy errors here, right? And so what we're interested in seeing, and potentially some negative R-squareds if it's really, really bad. But if you get some positive R-squareds here, that tells you that you can smell something good happening to those types of factor models in terms of their descriptive power. And so you can see that's the column that we focus on. You can look at, the traditional Gibbons-Ross-Shankin tests and p-values. They're not very helpful because they reject everything. Like, none of these models are any good. The absolute alphas are kind of an interesting smell test on the reliability of the model. The average time series R-squareds are kind of interesting to look at, but we kind of like this Cooper-Meow metric for the cross-sectional R-squareds. There's the unconditional R-squareds at the final column, but the constrained ones are the ones that we think is the best metric of success from a left-hand side approach. And you can see here that the market small and value factor model, which is sort of the equivalent to LTW, but built from the broader sample, not so bad, but you can get a little more action out of it if you throw in a network effect factor. And maybe, just maybe, the momentum one kind of plays a nice role in here, even though we kind of talked about how it's neutralized in the broader sample. It does deliver, notwithstanding that, a little more pickup. So we settle on this C5 model, which is the fourth from the bottom: market, SMB, value, momentum, and net. But we're going to keep the crypto CAPM, the first row, and also the LTW model for some of the experiments that follow. I'll skip this. These are some right-hand side experiments, basically maximize squared Sharpe ratio. This is Barillas and Shankin. It's an RFS paper I remember publishing, and it's a kind of a nice metric of success that's a little bit different. What it does is allows you to examine what the marginal contribution of each factor is to driving hard on the overall squared Sharpe ratio. And that also kind of is affirming of the 5-factor model. So third part of the paper, where we actually now try to think about segmentation in the marketplace. So none of this part of the paper happens without Song and Xiao, which is this cool paper that was published as a book chapter, and where it actually articulates the sort of the economic logic of what value from services these tokens can derive and how they function differently economically. And there's some really nice examples. I love, for example, in that paper, table 1 gives you some very direct examples and says, for example, Ethereum, that's clearly a platform token because it's basically a platform for smart contracts that gives you opportunities to do other kinds of activities from the base of the spine of the platform, as opposed to Dogecoin or Bitcoin, which are clearly more general payment types of categories. And in that paper, they talk about product and security tokens as well that are slightly different. Clearly, you can see in the table here, ladies and gentlemen, that the platform category, subcategory, represents by far the largest in terms of the count of the number of tokens. But, I mean, we can debate and discuss kind of hand waviness about whether we've got the right category. Should there be a fifth? Maybe there should only be 3. Maybe we should be combining these 2. We didn't do that. We basically said, okay, let's give Song and Xiao a good run for their money and let the data tell us. So what we do is we basically run these types of international asset pricing types of experiments. And so this is just, this one's just going to give you a little flavor. Let's do that experiment on network effects, but let's look how different it might be across different subcategories, the general payment versus the platform tokens, the product tokens, and security tokens. And what you can see here across the 4 rows is the spread, the high minus low, the simple 5 minus 1 spread is actually different across the categories. That positive affirming result that we uncovered for the overall sample, maybe not surprisingly, is primarily concentrated in the platform tokens. You don't see it in the other subcategories. So that's an early smell test that maybe just maybe there's some meaningfulness in these categories. I'm not going to lie to Will, Bin, and Wei. This is my favorite table because it's where we actually run a horse race for 3 models: the Crypto CAPM, the LTW1, and the C5 that are sort of favorite now. And what we do is we convert them into 3 different forms each: a global model where the factors are built from the entire universe, a local model where the factors are rebuilt but only locally into each of the respective 4 subcategories of tokens, and then an international version. You have to go read Ho, Karolyi, and Co to understand what this means. But we basically take those global factors then for the international version and break them into the local and the international, the foreign. So for the general token, general payment tokens, the international or foreign factors are built basically from the product, security, and general payment 3 categories. And what we're looking for is whether the cross covariation and the loadings associated with that have any explanatory power for the returns with beyond the equivalent of the market value momentum within the category of general payment tokens. And what do we see here? I mean, there's different ways in which we try and look at this, but what we basically see, I'll tell you the headline, is that the local factor models dominate. The local factor models dominate. And there's even the possibility of an inference that, on average, because this is on average, right, over this period of time, those outside the category foreign covariant structures really don't bear much on the cross-section of the returns within any given category, on average, over this sample. Way to go, Amin. This is the 4th finding, the new part of the paper that is really fun to see. And I'm going to tell you to not look at the right graph, only look at the left graph. These are now experiments where we're taking what we just showed you about this local market segmentation and the strength of the C5 model over this average period. And we're running this now first as a horse race among the 3 in terms of the average adjusted time series R-squareds across the 100 and some odd test assets, right? And we're rolling the window forward. Think about this as rolling in 2-year window, 2 years of running weekly returns, rolling it forward. And you can see that the C5 model clearly has, there's a nice white space gap between the Crypto CAPM for sure and the LTW3 model in this space. And sometimes the gaps get a little wider, sometimes a little narrower. Like even the most recent end of the 2021 period, you can actually see it's nice white space. Notice that it's coming down by the end of our sample, and that's something we don't know the answer to. Maybe one more minute. I mean, 1 more minute. So here's my.
No, you have 3 more minutes.
3 more minutes.
Yeah.
Well, I'll take 2. I'll take 2.
Okay.
So don't look on the right side, which shows you the marginal, the thing that was on the previous slide. Don't look at the right. Just look on the left. The left side says, okay, let's go with our C5 model. Okay, C5 model only, no comparisons across models. But we're going to compare the local versus the global one. The international one is not here, just to keep it nice and clean, okay? The blue line is the average adjusted time series R-squareds across the assets in that 100-week rolling window that we move through the sample period. And what you see, I think kind of cool, this is new, right, for the team, is that the local factor model on average dominates. Like you just draw a line, an average line through the blue and the red. The red is the global factor model, the blue is the local factor model. You can see that the local factor model is much higher average time series R-squared. Its descriptive power is much greater. But notice how it's coming down. And notice how the red one is coming up. Now, then sometime around 2020, both of them start to come down. which tells you that maybe there's an opening for some other factor that's not inside the C5, some sort of magical sixth factor that's not in the C5 that may be coming up the middle. But it's clear to me, I mean, clear to us when you look at this picture, is that more and more investors in the token space seem to be thinking more about spreading their wings beyond a subsegment within which they once were highly concentrated. There's more of an integration evidenced coming out in the wash in the returns. There's evidence of a evolution of greater integration over time. We think that's super cool new finding. So the paper ends by saying, we build this bigger sample, we affirm the evidence that is in previous papers of crypto anomalies, but we come up with some new inferences about just how reliable those are in the broader sample. We bring to the forefront a new C5, crypto 5-factor model that seems to do reasonably well as a workhorse. And then we actually give you some way of thinking about this in terms of economic functionality of these tokens, thanks to Tsong and Xiao, that seems to have some legs in terms of how it shows itself into the actual pricing and the actual returns. There's evidence of strong segmentation. No prior paper has documented this. And then for the whiz-bang finale here, there's evidence that this is evolving over time. There may be some evidence here that there's greater integration over time. So I will stop there. I mean, I probably went over.
Thank you so much, Andrew. Very interesting paper, very interesting presentation, especially those dynamic results at the end. It was interesting. So we have 10 minutes for Q&A. Please send your questions in the chat, and then depending on time, I'd go through them and read them.
Fantastic. I don't see the Q&A myself, right? So.
Yeah, no, because the Zoom setting is different. We don't have a Q&A specifically. You can send it in the chat.
Yeah.
So
and
right
I should mention that Will is also here in case I can't answer a deep question. And I think Bin and Wei Yi are here too.
So have anyone sent any question? Because I can't see it. Oh, okay, yeah. So I mean,
protocol factor.
Thomas is asking if there is any like protocol factor, like proof of work, proof of stake.
Yeah. Well, the headline today about Ethereum and their pivots, that was a big headline in the Financial Times this morning. And you know, I don't think we thought about building something like this, Will. But do we have through Into the Block capacity to actually build something like what Thomas is thinking about?
Yeah, so one exercise we could do is to group the crypto assets based on their underlying protocol.
Yeah.
But the truth is we're also looking at a number of DeFi tokens, especially post 2020, and they are not necessarily POW, POS based, right? They have.
So you could have other, you could have
proof
of work, proof of stake, and
other categories. But having said that, the merge itself, the merge itself is not going to affect the transaction cost too much, right? That was the original goal.
Yeah.
How it's going to affect crypto asset prices, at least a priori, is unclear. It could go either way. It's supposed to be priced in and all that. But definitely something we should explore a bit.
There's a great question here from Peter Kolm that I have the answer to this one. Have you done a PCA analysis of the cross section? The answer is no, we haven't. So here's what we've done, and I can give you a sort of a metaphor back to the 80s and 90s when we were doing this kind of asset pricing analysis. So we have not done a PCA analysis. We were true to the discipline of the Tsong and Xiao sort of pre-specification approach. And for those of you who are asset pricing experts, you'll realize back to the 1980s and 90s, where we had the original Roland Ross was the original form of deployment of APT model, which was a pure PCA analysis, yeah? And then because of the dissatisfaction with the PCA approach, along came Chenroll and Ross, where it was a pre-specification of macro factors, which was leaning right into the need or craving for people to have sort of a economic understanding. So what we did is we never did PCA, right, Will? And we have purely led with the discipline of the segmentation built from the Tsong and Shao framework. But now that we've done it, maybe we can actually allow ourselves to do a post hoc PCA analysis to see if there's any further validation of the structures. I think that's the way I think about it, Petter. I don't know, Will, what you think. It's a great idea.
Andrew, I think you put it well, and that's a great question. In fact, PCA is just one alternative, right? There are many other, even machine learning based tools that presumably can gain us some more power explanatory kind of in terms of R square, so on and so forth. We kind of view our study as a initial step, not the very initial step was done by Yukun and co-authors, kind of follow-up study to emphasize the segmentation and the dynamics of factors so that we can have a broader outreach to our empirical audience. But there's definitely room for pushing this further.
I think there's, for those who don't care about crypto space, I think that could be appeal from the segmentation analysis to the broader community, and not just international asset pricing types who might be interested in peeking into the crypto world. But definitely this is new to the crypto space. I don't think people have talked about the segmentation of subcategories. And Will, I'm not going to speak for you, but maybe the categorization that you built, the four buckets, may or may not be the right one. And there may be others, and it may be evolving and dynamically so. And I think we should be open to that. I think that there would be logical opening for follow-on work along those lines. Yeah,
absolutely. I think in practice, we also see people start to treat NFTs not as cryptocurrency. They used to be called cryptocurrencies, as all grouped together. But now people are careful in distinguishing that. So we can see the categories becoming more emphasized or salient in that regard.
So Amin there's another question in there.
Yeah, so the next
manipulation, this is for Will.
Are you talking about the last one? I think there is one before. The one that says, so because you don't see the momentum effect for smaller coins, which is in contrast to what you see in stock market, could it be because of some sort of price manipulation or like pump and dumps that you see this reversal in a smaller coin dominate the momentum effect?
Could be really interesting. Could you identify the pump and dump victims, Will?
We'll probably have to bring in, either Telegram channel or some, and Donghua Xin, Bolin, I think they've done interesting work on that as well. The general answer is yes, we need to bring in more data to look at it. We kind of acknowledge that's a possibility currently in the draft.
Yeah, because we're building from weekly returns, and my guess is the pump and dump stuff that's in some of these vulnerable tokens is probably going to be higher frequency. We're going to have to drill down a little higher frequency to get a comfortable look at that, and then pull them out and see if it's still there. That would be
right. And it's not, I mean, just to add, there are a couple of papers on pump and dumps. They show that the effect goes away like within minutes.
Within minutes even. So daily is no good. Daily is no good.
And maybe the effect on like your weekly returns isn't that big.
It's not going to cut it. Yeah. But it's not a bad idea offered here to give it a try, right? If it's no good daily, maybe then we can just give up, but it's worth an idea anyway.
One relevant issue could be that crypto prices are very noisy, especially on CoinMarketCap. Like they do some sort of aggregate pricing, volume-based aggregate pricing across different exchanges, and the noise which creates reversal that could be larger for smaller coins. Like maybe if you try just exchange level prices as opposed to, because when you do volume aggregation, depending on, even if prices don't change and trading volume changes, the weight is going to change because of the price difference. Is going to add noises. So maybe using exchange level prices can also, just as a robustness test, I can address that. Another question, actually, let me ask you a question myself. Like, I was very fascinated by the last graph that you were showing, the dynamic pricing.
Me too. Me too.
Yeah, and you said don't look at the right side. I did. Sorry about that.
Okay.
But like the right side graph, it seemed to me that that rise in local factors R squared and the drop afterwards, it corresponded to your network effect for, yeah. So that rise like in 2019, mid 2019, and then at the fall off, that corresponds to the blue line on platform local model, like the top right.
Top right here. Yeah. So it's dead. It's dead here. And then look at how much it picks up in 2020, the platform, the importance of network effects on the platform model.
Exactly.
Yeah.
And it's
we have not had the time, I mean, to actually dissect all this stuff.
Okay.
So these are the marginal contributions of each of the 5 factors in C5 over time in each of the 4 sub-segments. So this needs some real attention here. And you're looking for some big jumps in here, and I like it. I like it.
And given the number of tokens you have in platform local models, which is like your dominant category, it could be that that's driving it. It's interesting to explore what's going on there.
Yeah, yeah. So this is the overall, all 4 categories mixed together, and here's by subsegment. Thank you for mentioning this. I'll stop sharing, and we got to give Yukun some time.
Yeah, so we are right on time. Thank you, everyone. We're going to go to the next paper. Yukun Liu is going to present the economics of non-fungible tokens, co-authored with Nicole and Alex Sabinsky. The floor is yours, Yukun.
Can you see this?
Yes.
Okay. Thank you for the organizers to having me here, and Emin for hosting it. And it's great to be on the same panel as Andrew. As Andrew mentioned already, I was Andrew was my advisor back at Cornell, so it's great to be on the same panel for sure. It's my honor. In the language of Andrew's paper, or what Andrew talked about, there are different countries in the crypto market space, right? You can think about this paper studies a particularly, in my opinion, important country in that particular space, which is the non-fungible tokens, right? So this is broadly how we relate to the topic of today, right, which is about token classifications. We study non-fungible tokens, and of course, we're also going to dig into the different types of non-fungible tokens. You can think about the ones about avatars versus the one about Decentraland, or about the music, how their pricing behaviors is going to be different as a group compared to the other tokens market and the subgroups within the non-fungible tokens market. So let me get into this. So in this paper, we're going to understand the returns of the overall NFT market and the subcategories of the NFT market. We want to understand how this returns of the NFT market is related to the cryptocurrency market in general and the other asset markets, and what are the different properties perhaps about the NFT markets. To understand the NFT market, actually the first thing you need to do is to construct an NFT index, which is going to be different from many of these asset classes we're familiar with, such as equity or like crypto. We're all interested about in this whole panel. That the reason is because for NFTs, each one of them is going to be different from each other, as opposed to, for example, for Bitcoins, they're all the Bitcoins are, the same for each other. You can get, it doesn't have a Bitcoin 1 versus Bitcoin 2, like they're the same thing, have the same value. So, so in a sense, the NFT, it's more like housing or like an art, right? Each one is different and they're traded very infrequently. So we're going to have a method to construct this kind of particular NFT market, essentially using the repeat sales method. And then after that, after showing you how we construct this index and understand some of the basic properties, we're going to get into the predictabilities and what are the features about the return space about the NFT market. The way we're going to do that to construct this index is the repeat sales regression method, RSR. I'm going to talk about the reason why we use the repeat sales regression method later and how we exactly do that. For this talk, we're going to start from 2016 all the way to the end of 2021. So we're gonna not gonna capture the recent decline in the cryptocurrency value, of course, also the NFT value. So you're gonna see that it stops at the end of 2021, which we updated more recently, but it's not gonna be in this talk. On average, in this time series, we studied the weekly return of NFT is about 2.5% with the 19.2% volatility. So that gives you a 0.939 Sharpe ratio annualized. In terms of its exposure to the cryptocurrency market, there are some important exposures. However, the majority of the variations of the NFT market is still going to be very different from the cryptocurrency markets. Versus for the traditional asset markets, there's basically very little exposure above and beyond as connections to the cryptocurrency market. We're going to think about what are the return predictability properties of the NFT market, both in terms of the time series and here in terms of the cross-sectional. In the time series, what we find is that by far the strongest predictor is this valuation ratio, essentially using the index that we construct for the NFT market divided by how many times it's traded in the particular period. So in a way, you can think about that's similar to price to some fundamental value of the markets. In the cross-sectionally, we're going to find two effects. The first one is the size effect. Essentially, if the particular NFT is sold at a very high price, in other words, the size of this NFT is large, in the future, its average return is going to be lower. There's also going to be a reversal effect, namely that if the previous transaction of this NFT has a high return, in the future, that's going to have a low return. We're not going to find a momentum effect for the cross-section, and we think about, and the reason we think we don't find a momentum effect for this market is because on average, an NFT is only sold like 20-30 weeks apart. So it's very difficult to observe the short-term momentum effect. Even if it's there, on average, we're going to see that longer-term effects over there. So let's look at the data and methodology. In terms of the data, we're going to use the major exchanges, covering 5 exchanges right now. CryptoKitties, Gods Unchained, Decentraland, OpenSea, and Atomic. The last 2 are more general purposes. The first 3 are more about the specific collection. We're first going to aggregate the data to the weekly level. And we're only going to focus on the trades with the underlying currencies. It's either in Ethereum or some forms of Ethereum, Mana, or in US dollar. So what is this repeat sale regression method? Essentially, you can the difficulty about such an asset that is not traded very frequently, and also it's different from one to the other one. You need to think about what are the common components about the price movements. If we assume that the price movements or the returns of any particular NFTI has 2 components. One is the common component or the market component, BT parts, right? The market moves. And the other component is the idiosyncratic component, UI components. If that's the case, if you take a log on the left and right hand side, you're going to get to the bottom one over here. And econometrically, you can recover what BT prime and BT are, right? This is a standard repeat sales regression method. Perhaps we're more, the more famous ones in the repeat sales regression methods is the Case-Shiller method, which is putting some restrictions on the UIT parts over here. So why do we use this repeat sales methods? as opposed to some other potential methods. The first one you can do is this median floor price, right? That is going to be not very good at all, right? So it's largely discarded by the academic research. The reason is because, for example, if you use the mean one, which is the worst one, if there is a particular cell today, which is a very high price or very low price, right? That selection effect is going to completely change the dynamic of this index. So we don't want that. Median is a little bit better, okay, but still doesn't completely guard you from this behavior. Hedonic regression is another method you can do, essentially using the characteristics of the different kind of underlying assets. For example, houses, the square footage, whether it has some amenities or not, to do that. But here you can think about for NFTs, this is particularly difficult, although we're trying to do some extensions using the hedonic regressions compared with the repeat sales regression. We can think about like how do you compare some art pieces in the NFT market, such as the famous CryptoPunk or the Bored Ape, versus some virtual land, right, Decentraland, or some music pieces. That particular characteristics you need to choose is even difficult. And we know that those characteristics you choose has a huge impact on the results of the hedonic regressions. For repeat sales regressions, you won't have these problems. Of course, the drawback of repeat sales regressions is you need an asset to be traded at least twice to enter your regression. But here is less of a problem, and for some of the less traded markets, for example, like the art market, that might be a problem because you have very thin sales in any given period, such as a week or a month. But this is largely not a problem for the NFT market because the sales in the NFT market is like an order of magnitude when we have more than enough data to do it. So this is the first result. Just thinking about how much that common component, the B part, can really already explain about the cross-sectional returns of each individual NFTs. And that R-squared is pretty high. It's almost 30%. So think about what this means is that there are a large cross-section of different NFTs, right? There are like hundreds of thousands of different collections of NFTs today. However, their price movements just by one time series, it can already explain more than about 30% of those return movements in the in the whole panel. Within each category, within each collections here, those are such as the famous ones, the CryptoKitties, which perhaps is one of the earliest NFT collection, although we didn't call them NFT at that time, or the more famous ones, CryptoPunks, Bored Ape, some of the newer ones, Subducks, Decentraland. Within them, the explainative power, of course, is even going to increase, such as for Bored Ape, it's almost 90%. For the very different Decentralands, right? The different lands on the Decentraland can be very different. That's almost 50%. So with this 90% for the Bored Ape, or this like 66% for the CryptoPunk, what they mean is that, well, you really don't need to think about if you have decided to buy a Bored Ape or a CryptoPunk, there's really very little reason for you to think about which particular Bored Ape or CryptoPunk you want to buy. Well, because the common component explains the majority of the variation already. There's very little difference in terms of your realized returns or your expected returns for the selections of the Bored Ape or CryptoPunks you want to choose from. So let's look at what the market index is going to look like. So we start from 2018. That's where we have start to have data. For the beginning, a year and a half, most of the trades here are going to be CryptoKitties, because at that time, the only collection of NFTs is about CryptoKitties. After that, the number of different collections increased dramatically. If we look at the past like a week, there will be more than like thousands or even hundreds of thousands. There will be hundreds of thousands of different new collections. Of course, most of them are not very traded. You can see that we normalize the beginning to 1. you can see that at the beginning, a few years, the price of the NFTs dropped pretty significantly. But when it starts in 2020 onward, especially in 2021, the price increased by a lot. Right now, it's about by the end of 2021, it's about 5 times the beginning of the sample. Right now, it almost get back to a little bit higher than the beginning if you extend this time series all the way to more like today. What about the different collections? The different collections has vast different properties. For example, for CryptoKitties, this is similar. The beginning is exactly the same because the only sales at the beginning are about CryptoKitties. Later, there will be important divergences, but by the end of the 2021, the price level is about the same. CryptoPunk and Bored Ape, the two famous ones, of course, their prices went much higher than the index, the average prices. For example, for CryptoPunks, if you buy one at the beginning of its sales, you get 1,000 times. Right? This is not a typo. 1,000 times than what it was at the beginning. For Bored Ape, it's about a little bit less than 200 times compared to that at the beginning. But of course, this is selection, right? Because the reason why we know them is because they went up in prices so high. The Essential Land, on the other hand, this is also a famous collection about digital land. However, the prices actually didn't go up as much for the majority part. At the end of it's about the same as the index price. We also categorize each of these NFTs in different categories. The blue one here is the index prices. So now we start from 2020 instead of 2018 and normalize that to 1. There are different kind of collections of NFTs like the avatars, virtual worlds, and other things. You can see that the price, they move in at even given point in time, they move in the same direction, more or less. However, the level of them can be very different at the end of the sample. Okay, so this is summary statistics. If we look at that, that tells you the average return is about 2.5% in this whole sample, with a standard deviation of 19.2% and a Sharpe ratio of 0.94. At the beginning, the returns are largely negative in 2018, 2019, but starting in 2020 and 2021, the prices went up pretty dramatically. So let's first look at how does the NFT is different from the other markets, such as the normal cryptocurrency markets. If you regress look at the exposure of the NFT market on the cryptocurrency 3-factor model, okay, and like also putting in the value, what you find is that the other things really they have no exposure to that at all, but it does have some exposure to the cryptocurrency market, with the R-square about 21%. So what this means is that, well, of course, the NFTs are typically denominated in cryptocurrencies, so that already perhaps give you some connections over there. However, the vast majority of the variation of the NFT market is not driven by the cryptocurrency variation. About 80% of that is not driven by it. It has some exposure to the stock market. However, if I control for the cryptocurrency market, this is largely gone. So this exposure to the equity market is mainly driven by the fact that in the more recent sample, the cryptocurrency has exposure to the markets. Okay? So that's the reason why it is significant. For the other commodities and things, the exposures besides for some the commodities is largely absent. But this, I think, is also interesting. So this is thinking about some of these coins or tokens in the cryptocurrency space. They are mainly about they have an NFT theme to it. So let's see if these coins, whether their correlation of the NFT market has above and beyond just their correlations with the general cryptocurrency market. And we do find that is the case, right? even if it's controlling for the cryptocurrency market, that is still going to be significant, suggesting that these coins, they do get affected by how the NFT market is doing overall. And that effect has a significant lag. If you look at the time series, essentially, when the NFT market goes up, at the same time, those coins about the NFT is going to go up, but that takes a long time for it to completely absorb that effect, about more than 2 weeks. In terms of return probabilities, I'm going to briefly talk about time series ones. Essentially, we check a bunch of different things. The one that is most reliable is going to be this valuation ratio using our index, which is the market price, divided by some form of kind of fundamental value, which is using the transaction counts to capture that. You can see that when this index, this ratio is high, the future returns of the NFT market is going to be lower, right? So very much similar to the price to dividend ratio. There's also some evidence that the volatility is negatively related to the NFT market returns, but that's mainly on the long run if we're controlling for the valuation ratio. This effect of the valuation ratio and returns is very large. A one standard deviation increase in the index is associated with 19.1% decrease. So this decrease of the future cumulative NFT market returns. So the last part, in the last 5 minutes, I'm just going to talk about the cross-sectional return predictabilities. What we find is that there's going to be a size effect, and also there's a reversal effect. To detect these cross-sectional effects, we're going to modify our baseline repeat sales regression with the additional terms here. So what this is doing is telling you what if the price of that particular NFT that is being sold in the first time is high, does that lead to, on average, high returns into the future or not? Or lower returns in the future or not? You're going to find that that is the case. Okay? On average, if the price of that NFT being sold is high, the future returns of that NFT is on average lower. That's true for the full sample and each of these collections. If you double the log NFT purchase price, that is roughly associated with the 0.4% decrease in the weekly returns going forward. And that's pretty significant decline in the weekly returns. And the last part is thinking about the zero dependence. So here we need 3 cells instead of just 2 cells, because I need to observe the first repeat sales of that NFT, look at the previous returns of this NFT, and thinking about whether that is related to the future NFT returns. So putting in the returns, the average returns, average weekly returns of the NFT in the past period. You can see that there's a very strong reversal effect, namely that if the returns of the previous sale of this NFT is high, the future returns is going to be lower. A 10% increase in the average weekly returns of the NFT's previous repeat sales, that's roughly associated with the 0.14% decline in the weekly returns. So this effect is a little bit smaller than the previous ones, but it's consistent across all the different sub-collections in the full sample still. So let me conclude on this. So in this paper, what we do is we construct indexes for the NFT market, both for the full market and then also looking at the sub-markets. We think about how is this NFT market? It's a part of the whole cryptocurrency family. Is different from the typical cryptocurrencies we think about, the fungible cryptocurrencies. And then we think about what are some statistics in time series cross-sectional return predictabilities. Yeah, thank you.
Thank you, Yukun. Very interesting paper, interesting presentation, and a very interesting market. So if you have any questions, please send them in the chat. Let me ask you a clarifying question, actually. So the last results that you were showing on the reversal, was that a market adjusted return or just raw returns? because I want to see to what extent it's influenced by the whole run-up in the market, and then
Right. So you can think about that's already market adjusted already. So let me put that back in here, right? Just briefly, because this is on top of the BT prime and BT, right? This is the common component that that index is trying to capture.
Right.
So this is all about the part that's above and beyond this. You can think about the RIT minus this part, right? That's the market price. Yeah.
Great. Any questions? If not, I think we can conclude because we are a bit late on time. This is actually perfect timing. I mean, we are right at 12:30. So if there is no other questions, thank you so much, Andrew. Thank you so much, Yukon, and all the organizers, Fahad and Will.